Getting taxes right is one of the surest ways of boosting your investment results. You can't control market volatility, but you can control your tax decisions. Unfortunately, I see a lot of mistakes that really cost individual investors on their taxes. A lot of missed details, not knowing about tax savings opportunities, or even just not prioritizing right. So today I'm going to talk about some of the biggest tax mistakes I see individual investors making. The first is owning too much in high income investments. Dividends just aren't very tax efficient. If you own a dividend heavy fund, you owe taxes on those dividend payments when they are released. Whereas a fund that makes most of its money from price appreciation, you only owe tax when you sell that fund. What this means is that those price gains can keep compounding year after year until you finally sell it. Whereas on that dividend fund, that money you send off to the IRS never gets to compound again. Even worse is if you're holding funds where the income generated is taxed as ordinary incomes. This includes things like high-yield bonds, option-based income strategies, etc. Regular stock dividends are taxed like long-term capital gains, but ordinary income is taxed at a much higher level for most people. And so for a lot of investors, the after-tax return on these ordinary income investments is actually quite small. The second big mistake I see people making is not maximizing all the different account types that you could. So there are a number of investment account types that can save you a lot on taxes if you use them right. There are 529s, HSAs, 401ks, Roth IRAs, well as a number of others. There's different rules for each of these, and that includes how deposits work, how withdrawals work, how the taxes work on each of those, who's eligible. So you personally may benefit a lot more from some of these than others. I'm not going to go into all the details how each of these account types work, but it is imperative that you understand how they might work for your personal situation and take advantage of as many of these as you can. The third mistake I see commonly is not tax loss harvesting or not doing it right. I actually rarely see individual investors doing tax loss harvesting right on their own. Now, most advisors will do it, but even there, I honestly rarely see them doing it right either. So tax loss harvesting is where you sell one investment that has declined in value, and you buy some similar investment with those proceeds. And so for tax purposes, selling the thing that is at a loss gives you something of a tax write-off that you can use to offset capital gains you have in other parts of your portfolio, while the fact that you bought something similar means that when the market rebounds, you're still participating to the upside. The concept's pretty simple, but there's a lot of pitfalls in the execution, like what replacement security should you buy? You got to deal with something called a wash sale, the timing, like when is the right time to take the losses. So all these things, all these details really matter quite a bit in how much benefits you realize from tax loss harvesting. We recorded a whole video on how to do tax loss harvesting right. So if you want those details, you can check out that video. I'll just say two things about tax loss harvesting here. If you're going to try to do it on your own, just be really careful that you follow all of those steps. And then also, if you do have an advisor who's doing this and they're only doing something like checking once a year for losses, maybe you find another advisor. The fourth big mistake I see is hanging on to a bad investment just to avoid paying a capital gain. Arguably, this is the biggest mistake of all the ones I've talked about in this video because it's the one that can cost you the most over the long term. So say you own something in your portfolio that for whatever reason is just no longer optimal. Maybe it's a mutual fund that's just too expensive, or maybe it's a good stock that's just appreciated too much in value. A lot of times people become frozen by the tax consequences of making a change in these situations. Maybe you've held on to the stock or the high cost fund for a really long time, and therefore there's a big gain. And so even making a small change could cost you a good bit on next year's taxes. So if you're in this situation, just remember two key things. One is that the problem is not going to go away on its own. That's because only one of two things can happen, right? Like either the stock goes up, but then it's even more concentrated in your portfolio and the tax bill for selling is even higher, or the stock goes down, erases your gain, and you wish you would have sold and just paid the taxes. The other thing to remember is that unless you're going to die holding this stock, you will pay tax on it eventually. It's just a matter of when. Do you want to pay the tax now, or do you want to pay it later? Now, all else being equal, paying later is better, but all else being equal is really, really key here. It's much more important to own the right investments than anything else. In other words, it's much better to pay some tax now, get yourself in the right portfolio, versus go years and years in the wrong portfolio just to avoid taxes that ultimately you can't avoid anyway. So look, if you take nothing else away from this video, please just remember that paying tax is part of making money. Building a tax-efficient portfolio is definitely important, but not at the expense of building the portfolio that's right for your situation. But hey, what do you think? Do you know of some other tax mistakes you see people making? Put a comment in the comments section. I'd love to respond to anything I see there. And if you like this content, we're going to be coming at you with more thoughts on investing, what's going on in the world, and the White House, and the Fed, and the markets. So hit that subscribe button. You'll be the first to know when we've got a new video. We'd love to see you again.